Now, what are some? I think when you deal with the big items of independence and conflicts of interest, you can see where the CPA has to walk very, very carefully. Okay, you've got to have your antennas up and know that danger is afoot. What are some, I guess, items that could arise in everyday practice that could potentially give you a conflict of interest or potentially compromise your independence? Well, contingent fees, okay? Can a CPA get contingent fees from a client? Well, yes, but only under very, very, very limited circumstances. So clearly, if you need to have independence, i.e., a special level of independence. I mean, all CPAs need to have independence, but if you are in audit or attest work, your level of independence actually ratchets up a little bit. Okay, so tax people within the roles of Circular 230 and as a tax professional, there are times that you can act in a limited way as an advocate for your client, but there's still a level of independence. Whereas audit people or attest people who do attest work, you have your level of independence is even higher. So in that particular case, if you do audits or you prepare an original tax return. Or if you prepare an amended return, assuming that you did the original return as well, or you're acting as an expert witness, you cannot receive a contingency fee because that would potentially cause you to sway your viewpoint on the client. Because if you didn't achieve a goal or didn't win the lawsuit, you wouldn't get paid. Okay, and so the board wants to the AICPA wants to kind of take that out of the equation. So you're not allowed to have contingency fees in those particular situations. Let's look at other issues that would cause you to that would be a direct impact of losing your independence. Well, if you lost your independence, that could cause you into having a knowing misrepresentation. You could commit a knowing misrepresentation under certain circumstances. So, what are examples of knowing misrepresentations? Well, that's making or directing another to make materially false and misleading entries in an entity's financial statements, or failing to correct an entity's financial statement or records that are materially false and misleading when you have the authority to record these entries, or signing or directing another to sign a document containing materially false and misleading information. What is an example of that? Oh, good golly, Buca de Beppo. Okay, I don't know if you're in your part of the country whether you have these restaurants, but we have them in my area, and they're basically a chain of Italian restaurants that were, that are very popular. Now, in this particular case, it's a crazy situation. The founder of Buca de Beppo, in the years he'd owned it, had eventually agreed to let Buca de Beppo become publicly traded. So they did an IPO a few years prior to this, and so the founder's role was still significant, but obviously they were under the additional rules of the SEC at this point, being publicly traded. And unfortunately, what ended up occurring in Buca de Beppo was the founder was ultimately found to have flushed a large number of personal expenses through Buca de Beppo's checking account. He ended up having a bunch of yes men around him and had these personal expenses, including a villa in Italy, which had been redecorated on Buca's dime, and some very fancy cars and some other types of extremely personal expenses that were being run through the financial statements and expensed. And so, and then on top of it, to add insult to injury, it was found that the CFO had gone ahead and created a so-called consulting company. He co-owned it with somebody else, but he was a principal in this consulting company, and got Buca to hire his company. And as it was found out in the federal indictment, that there was very little services actually being offered by this technology company to Buca, yet the technology company was being paid a king's ransom for their quote-unquote services. And then it was, and there was also a variety of personal expenses being flushed through the financial statements for the CFO as well. And then the controller apparently was willing to go ahead and approve these checks being cut to both of these gentlemen. And so obviously the situation was found out, and Buca, in a federal indictment that was handed down a few years ago, the founder, the CFO, and the controller were all subject to these indictments, and it ended up in jail time for all three of them. And so clearly that was a huge conflict of interest for in many ways, and it showed a complete lack of independence at that juncture, especially as it pertains to the controller. And so clearly that is a cautionary tale of how to do things absolutely incorrectly in many ways.